This is the Asia Climate Capital podcast hosted by me, Joseph Jacobelli. The series is dedicated to discussing and analyzing business and finance topics around the energy transition and decarbonisation in Asia, with the capital markets in mind. Welcome to the Asian Climate Capital podcast. I'm your host, Joseph Jacobelli. Today, our guest is Robert Todd. Robert is an old friend. We're actually colleagues a couple of decades ago, and he's now the managing director in Energy and Infrastructure and Transition Group at CIBC Capital Markets. CIBC is the Canadian Bureau Bank of Commerce. He's based in London, and he has a global remit. Today, we're going to be focusing on what kind of global lessons can be learned when it comes to clean energy projects financing for Asia. So I want to welcome Robert Todd today in episode 11 of the Asia Climate Capital podcast, which we are recording on the 1st of July. Good morning, Robert.
Hi, Joseph. Good to see you, my friend.
Thank you very, very much for doing this. I know you're very busy with all of your deals globally, so I'm very, very grateful for your time today. So I wanted to start first with just a very quick, profile on, how did you get involved into the energy transition and decarbonization? Maybe tell us a little bit about, your journey, briefly about your journey to decarbonization.
Yeah, thanks, Joseph. And once again, thank you for the kind invitation to speak with you today. Really looking forward to it. So my journey began in renewables, I suppose, back in 2006, funnily enough. I was working in London. We're looking for a new experience and decided to move to Asia at that time. We had some long-standing family connections. I changed employer at the time. I joined HSBC. And then also, I've had worked on a few renewable-related transactions, which interested me a lot. And I had the opportunity to really focus on that segment. So I spent the next 10 years living in Hong Kong, focused exclusively around renewable energy, before moving to London in 2016. Stayed on for a few years there, but now I've moved on to a Canadian firm, CIBC, so a company with a 150-year-old history and a strong pedigree around energy and infrastructure, and as an exciting plan here to grow our platform more globally. And I remain passionate around renewables, but actually increasingly what I'm finding is my time is increasingly spent in the broader energy transition. So all sorts of different technologies and such beyond the core renewables. And that's what I'm focused on today.
That's great. And I think that, you bring your Asia expertise and then your, European/global expertise to the listeners, which I think is really, really going to be very useful. Now, if we just get into, the kind of conversation and very broadly, what are the key trends that you see today, whether it's in Europe, US, or elsewhere, which, you have not really necessarily quite appeared in the Asia-Pacific region yet? I know it's... I'm starting the conversation with a very tough question, but perhaps you can give some of the broad trends, and then some of those that may not appear in Asia yet.
Sure. Well, maybe as you say, set the scene a little bit, and I'm sure we'll dive into some of these topics a little bit further over the course of the discussion. So I think the first thing to say is, we're now more in a physical environment. Last year, of course, was fully virtual. And I think that's a positive thing. We have massive tasks to do, and particularly when there's a relationship element, it's much more conducive now, being able to meet and travel again, albeit on a more selective basis. We do have huge ambition ahead of us all. In fact, one client was telling me last week, it's like landing on Mars, not the moon here, in terms of what's required in terms of the energy transition. And with that, he also reminded me that, no new primary energy source introduced over time, and you think back through when coal came to the fore, oil and then gas, has ever cannibalized an existing source of energy. And I suppose now we're looking at a situation where, can renewable energy truly replace fossil fuels? And that is the big open question, I suppose. So, 2020, we saw the sustainability topic much more elevated, during the onset of the pandemic. In 2021, we saw a lot of policy formation. We had COP26 and the ratcheting of targets and takeaways. And then, of course, this year, 2022, is really all about acceleration, mega scale, how to move things forward more quickly, and how do we particularly address the ambition gap to move things ahead. So with that, we see records continue to be broken in new areas like offshore wind, both in Europe, both in North America, and of course in Asia, offshore wind is beginning to move forwards. We're seeing new technologies, long duration storage, not just batteries. We're seeing green fuels emerge. We've seen some significant transactions, particularly in Australia and the Asia Pacific zone, but in Europe, and we're also seeing those in North America as well. So that's encouraging to see. We are reminded, though, that the transition won't be smooth. We see the volatility of energy prices. We see an increasingly sort of inflationary transition as well. Rising interest rates, of course, and then close to home here, the sort of tragic conflict that we see playing out has really put a big emphasis on energy security as well. So if I was to crystallize sort of three themes, I suppose, which we're seeing and having live conversations with clients on today, I would say, first of all, the role of partnerships is crucial. We see the increasing scale of development. And I think importantly, beyond the capital itself, I think the focus really is on synergies. What makes a good partner for me today? What type of synergies, features, characteristics could my partner bring to help deliver a successful project? Another theme we're spending time on, I think there's a sort of shift away from just single assets, more to systemic changes and integration of new technologies. So it's not just about renewables. It's really about how do you bring together systemic change through an integrated approach. And that obviously adds a lot more complexity. And then finally, on the sort of transaction activity side, what we're seeing is increasingly, cross-border partnerships, cross-border technologies and collaboration. So I think really truly believe that, you need to bring a global mindset and sort of learn collectively, in order to support our clients who are often trying to develop projects or find partners in all parts of the world, Asia Pacific included. So yeah, those are the sort of three areas, Joseph, that I can see the most conversation happening today.
So I think so just to quickly summarize, it's the role of the partnerships, the shift from single assets to more the systematic change, and then also the kind of cross-border partnerships as well. Have you seen a lot of European, basically non-Asian players increasingly looking at Asia from the developer side, from the operational side? Not so much capital, because capital, we can talk about the capital flows in a minute.
I do. I see also clients from North America with the same dynamic, looking at entry point to Asia. I think a number of groups, recognize the future role that Asia Pacific has in the global economy and the growing proportion of activity that represents. And so it's important for these groups to establish a footprint. And I think the challenge for them historically has been, what is the addressable market in Asia for me? What is the edge I can bring? There's knowledge, there's know-how, maybe there's procurement aspects and so forth. Maybe it's a new technology. So that has been an area, I think, of big focus. And when clients start to think about how do I prioritize which of the regions, which have their own characteristics, of course, throughout Asia, which can be quite different, is to really think, how do I prioritize which of those geographies I can be relevant in. And then as part of that, back to the partnerships topic, who would be a good local partner, to work together with. And perhaps there's a reciprocal element to that, because we see the outbound theme, of course, which continues as well with Asia Pacific companies too. And that could be the basis of a positive relationship.
That's really interesting. When it comes to, as I mentioned just now, the capital front, so how do you assess or view the supply of capital to finance, the decarbonisation, clean energy projects in Europe and elsewhere in general? And then, as a follow-up to that, do you have any thoughts on, capital flows to the Asia-Pacific region specifically?
Well, the first thing to say that the role of private capital has and continues to grow very strongly, and the allocation that we're seeing towards the broader decarbonisation space is growing. So they could be well-known household names who are perhaps allocating within existing funds or portfolios increased capital, or we're also seeing the formation of new organic platforms which have a specific investment remit, even to the point where there's one single technology. Like there are dedicated hydrogen funds today in Europe, which are focused on that topic across the value chain. I think one other trend that I've identified too over the years, it really began that this was a renewables fund and all we do is solar or wind, what have you. There was then a move towards perhaps broader ESG, but I think the flavor at the moment is a sort of energy transition fund, if you like. So rather than pure clean day one, it's more the high carbon to low carbon story. So actually those funds could go into stories where there is a carbon component today, but the point being that there's a trajectory in order to support those projects or companies along their journey to net zero. So I think that's an area where the addressable market is under question. What makes an interesting investment and fit the protocol for that type of fund. But we do see some very significant funds being raised with that purpose in mind.
And do you still see this, despite what's happening in Ukraine with Putin's invasion there, and do you still see momentum? I guess because of the energy security, or as things kind of slow down a little bit?
Well, there's no doubt that this action has caused people to really rethink, what is our plan for, collective energy security. And so you've seen the result of that perhaps through, as an example, the Repower EU plan, which has significant targets. As an example, the production of 20 million tons of green hydrogen by 2030, 10 of which would come from within the EU and 10 of which can come from outside of the EU, and other regions of the world, will contribute to that. That's clearly a very significant target, and that pathway is still very much in formation. So I think it really reinforces the themes that what were there before from a sustainability perspective, but this clearly enhances the momentum significantly.
Shifting gear a little bit and talking about the kind of what's happening with the capital. I've got a view, and I guess sort of quite a few people share that view, that the supply of capital is probably outstripping right now the amount of investment possibilities or investment currently available for clean energy projects. So, i.e., more money than projects. And and I'm not sure if you agree with that, number one. And then number two, well, actually, let me just ask you that. Is that your view? Do you share that view, or you have a slightly different view?
Well, let's look at maybe two different parts of the value chain, I suppose, for this. I think if you think about the technologies, perhaps first, and then we can think about the projects. So, we do see significant funding coming into what they're calling climate technology segment, which encompasses a whole number of different areas, but fundamentally the technology, not the installations themselves. There was an interesting comment recently, from Larry Fink, which quoted him to say, he believes the next 1,000 unicorn companies will actually be known as sustainable scale innovators. And they won't be search engines, they won't be social media companies. And so from a technology perspective, there's a huge amount of activity around that area. It's still not straightforward, of course, when you're in a young company with a Series A, B, C round in order to secure funding. A recent project we worked on in the long duration technology space was a significant exercise, and positioning yourself as a company that's ready for that bridge to commercialization is quite tricky, and it requires some track record and other expertise and skill sets and so forth. So I think on that side, we see a huge uptick, and we see more allocation of capital coming in, and there's a growing number of targets, to your point, companies and opportunities in that space. So that's more upstream. If we look more at the sort of infrastructure area downstream, infrastructure, energy infrastructure, generation, and so forth, I think what we're finding is that investors are a lot more discerning these days around what they will actually target. And so we see the full evaluations for either assets or platforms where there's a development component, particularly where there are sort of positive characteristics, should I say. For example, maybe they've got legacy pricing and terms, on the equipment. Maybe they have a contracted profile. Maybe that's a long contracted profile rather than a short one. Maybe they have specific equipment that differentiates them, or particular counterparties. So where you have those types of characteristics, I think what we're seeing is we are seeing full evaluations, because investors like what they see and they're willing to pay a premium, to get into those. I think where you start to see areas where either there's less appetite or more subdued valuations is perhaps in some of the areas where there are new business models which are less proven, perhaps where there's a more an increasing sort of merchant component to the story, whereas perhaps they would have used to being seen a more contracted component. Perhaps if there's a technology which is a new model or a new approach which hasn't necessarily got the in-field track record that others have seen, that's where you start to see a more conservative set of underwriting assumptions, I would say, from investors. So I think what you say is generally true. There is significant capital coming in, but underneath that, the types of investments is more diverse, I suppose, than perhaps it was before in the clean energy space.
Any impact on valuations? Have you seen kind of valuations going anywhere in the last 12 months? I mean, going up, going down? Valuations of projects specifically, not the complex technologies.
Yeah, so I think, and we're at an interesting point here as we sort of enter a new chapter with a higher, with the sort of macroeconomic indicators, I suppose. But before we look at that, maybe in the last 12 months, we've certainly seen a huge amount of euphoria around high quality opportunities. And let's look at platforms. So what I mean there is development platforms that are creating new assets, building new projects, and so forth. And there's been a number of acquisitions of those platforms over the last 12 to 24 months. And I think what we've found is that the sort of methodology of valuing those types of platforms has shifted. So whereas perhaps years ago, the conventional approach would have been to value the in-hand pipeline, the projects that they own and operate perhaps already, that's now shifted to also include sort of going concern aspects, to say, well, actually, this team, they can deliver market share and new projects into the longer term beyond projects that they have today. And actually, I'm willing to ascribe some value to that today. That all comes under the general banner of more of a sort of terminal value type assumption. But we've started to see, or we did see, platforms trading with terminal values of over 30, 40% of the day one value. So you can imagine that investors were ascribing quite significant value to that perceived capabilities of the platform and to deliver projects over time. And I think what we'll see now going forward, we're at an interesting point where, as I say, we're entering more of a higher inflationary period. Rates have been on the increase. There's corresponding impacts around debt financing costs, potentially equity, although we haven't seen necessarily those movements yet. And I think it'll be interesting to see, will investors ascribe the same level of conversion rates on what a sort of a gross pipeline looks like versus a net build basis? Will they look at the economics of that pipeline and say, look, development premia are more subdued because of these reasons, and how that will translate into the overall valuation? So it's still reasonably early days with that backdrop in mind, I suppose. But certainly we have seen a lot of enthusiasm just because the wall of money has grown. Strategics have put very significant targets out there and they need to meet those.
I guess you answered already my next question, which was, does the current rate of interest rate increases, current pace of interest rate increases going to dampen investment appetite, or is the drive, kind of the clean energy drive, decarbonization drive, drive towards energy security going to kind of outstrip this?
Yeah, I think this is definitely an area of caution for everybody. I think the immediate impact is really through the debt costs, of course. When you think about how you price products in that space, let's see, in terms of where all-in pricing moves to over the course of the next year or so. But no question that has a more of an immediate impact, on projects and sponsors. A slightly more moderated impact, I think, is through expected equity returns. And part of that, to your point, is just the enthusiasm, the competition around situations. So if that continues, then we're likely to perhaps see some sustained sort of competitive rates of threshold returns on the equity side. But even then, through live processes that we're involved in, we can see that there's more differentiation and perhaps differing approaches that investors are looking at. They're going through their sort of quarterly portfolio review cycles and valuations and such, and they're reviewing, what are reasonable returns in the current market context. And so I think that is a sort of live area of discovery at the moment.
One question that I'm personally, as you know, I do some direct investments myself, and one of the things that I've kind of found surprising is the lack of initial public offerings in the clean energy space globally. I mean, it's a huge theme. Everybody's talking about ESG, sustainability, decarbonization, et cetera, et cetera. So you'd expect a lot of equity markets activity on that front, but at least in the region that I'm familiar with, Asia, I haven't seen a massive amount, and I don't believe we've seen huge amounts in Europe or the US. Am I correct? And with this kind of view?
Well, that has been true of late. If you do go back to maybe early 2021, there was a window of enthusiasm, if you like, and there was some tremendous examples of, not just sort of conventional IPOs. I suppose there was the phenomenon of the SPAC, which effectively raises proceeds with a sort of a story and a concept for younger stage companies to achieve a public listing. And there were some really good examples of companies that took advantage of that window. Now, through the course of last year, that window did close, and for a number of different reasons. I think what we've seen, and it links back really to what we said earlier too about capital inflows, that the role of private capital has become very significant in this area, and in many situations, the superior valuations and the willingness to ascribe value to, for example, the development for independent players and such, has been higher in the private side versus what could be potentially achieved in the public market. So, with that in mind, you've seen folks opting to go down the private capital route rather than necessarily the public route. So, having said that, there have been select examples, that have come to market. There's been some interesting groups with sort of broader sustainability type investment remits. There's been a couple of IPOs in London, the Victory Hill, Hydrogen One, which have been successful listings. And so they do take place, but I think you're finding that there has been, fewer than expected in this space.
Got it. So I guess we can move on to the the part three of the interview, Robert, if you don't mind, which is please take out your crystal ball and talk about what's going to happen over the next 28 years. In terms of like decarbonization. So how do you kind of see the financing of clean energy projects evolving over the next, 1, 2, 3 decades? And I think the reason why this is important is because, and I always remind listeners of this, that when you invest in energy, it's not a one-day investment. It's not a one-day trade. You're buying into assets that are going to be operating for 20, 25 years or even longer. So that's where that question is coming from. So how do you kind of see things evolving and any particular milestones?
Yeah, well, we have to hit net zero in our lifetime, Joseph, if not maybe career for young people like yourself. So there is a lot to do. It's a massive ambition. I think it's worth saying that the mindset and this shift that we referred to earlier around looking at single assets versus systemic sort of change, which then leads to the financing of those is a key area to think about. And how do you finance systems versus single assets? I think we're all very used to project finance, single or portfolio of assets in a sort of discrete perimeter, and I think those issues are more tricky. If you think about, for example, in the UK, an industrial cluster, how does a cluster become net zero, and how do you effectively finance that? What is the right capital structure for that sort of group of technologies, group of activities in an area? And so I think for those types of situations, there's going to be policy formation to support those aspects, and that's something where there will be greater clarity on, certainly here. In the meantime, there are clients, there are groups who are really trying to, be first movers around the space to try to establish, a business model, establish a footprint, a structure that could be, so-called bankable, and bring that. And there are efforts in other sort of adjacent technologies as well in that space. So you see examples now of standalone battery financings, EV charging financings, and so forth. And those incorporate a number of those new components around stacking of revenues. For example, the luxury of sort of feed-in tariffs for the full life has effectively gone now. So, how can you build a bankable story around the revenue side? That's important. If it's aspects like merchant risk, utilization risk, how do you build a story around that? What are the sort of debt sizing parameters that you could credibly attach to those types of situations? So it really requires, I think, some sort of financial innovation, if you like, using some of the historical techniques. It's not reinventing. It's more about evolving structures and approaches that we've had in the past, but putting them into new applications and then trying to convey and test ourselves to say, is that bankable? Because we really do need to mobilize, significant funding in order to support this transition. This is not an equity only situation. We need financing. We need all sources to come to bear here. So at this stage, a number of those technologies are in formation. So there haven't been many examples. But one thing, and this is what we're also doing in-house here, is to try to bring together a convergence of skill sets to give that the best opportunity, and not just that, but to drive those ideas and to drive what those structures could look like. So, for example, we've sort of integrated our upstream business, midstream, power and infrastructure businesses into one area, so that we can bring skill sets. And increasingly, we find that situations involve different skills, whereas perhaps it was a siloed skill, maybe just a renewables only, or perhaps an oil and gas related transaction. Today, we actually need to bring skill sets and insights from different parts of the organization more than we did before. So that's both on the banking side, it's together with our risk partners to make sure that we're all thinking along similar lines, and really trying to help sort of drive drive those conversations with our clients. So that's been quite a big change, I think, in mindset I've found over the recent years. And this applies globally. This isn't just yes, there are sort of bespoke issues with different countries and so forth and regions, but it's a mindset shift that we all need to adopt, I would say.
Yeah, I mean, I think we've seen that globally, and in Asia, I experienced it as well, where you have the commercial bank, be it local or be it regional or be it global, not really understanding the product, i.e. the clean energy project, not really being able to get its head around the risk profiles, et cetera, et cetera. And I think over the last few years, that's kind of improved in places. I think Japan is one great example where the banks, when solar first appeared about 15 years ago, had absolutely no idea what it was and were not keen to get into it. Where now some of the big banks in Japan are looking at financing offshore wind, which itself is very, very challenging for a whole bunch of reasons. So the human capital side, I think, is sometimes underrated because everybody talks about the finance, the technology, the big projects. But at the end of the day, the skill set is actually quite complex. So I would tend to agree with that. So just to wrap it up, any kind of final thoughts that you have on global lessons for Asia clean energy projects financing?
Well, I think thanks, Joseph, for the kind invitation today. I've really enjoyed touching on the key themes of the day that we're seeing. I think in our minds, we're really trying to see how we can supercharge our organic growth in this area. That's hiring ourselves significantly. That's adjusting our own sort of model in order to support our clients. I think nowadays what we find, clients want strategic partners. They want people who can help them in projects, enter new markets, deliver projects economically and on an accelerated basis. But they need capital partners as well, and that's where we fit in. So I think a closeness of the relationship, advice, arranging capital markets in a sort of an integrated way, where you build those relationships is really critical. And we find that with our clients, in particular through some of the issues that they're grappling with today and trying to navigate. That's increasingly important. So we're very focused on it. We're excited about the area. It's critical that we move forward quickly here, and opportunities to share some of the insights with you today is a positive step. So I really appreciate that.
No, thank you. And again, I hope that this knowledge sharing is helpful to all the listeners. Well, listen, Robert, thank you very, very much once again. And we're doing this internationally today, given that you're up in the UK. And so, yeah, just thank you for participating in this episode of the Asian Climate Capital Podcast.
Great. Thanks, Joseph. Really appreciate it.
Thank you for listening to the Asia Climate Capital Podcast. If you want more information or you would like to send some comments or ideas for future topics, our contact is in the show notes. Thank you again.